Hey, good afternoon, everyone. Good afternoon. How's everybody?
Good.
All right, good. How are you, Nastasha? I
I'm
see
doing well.
great, great. There's Naomi, Finn, Ariane, Dinkang, and Tohao. All
Hi,
right,
Professor. How are you?
good. How are you, Ariane? How are you? Uh,
I'm good.
okay, you sound a little, you sound a little tired. Um, well, I'm glad that at least I mean, this is uh, unusual. I mean, non-regular schedule. I'm sorry, non-regular schedule because normally we don't meet on Thursday, but as pre-announced, this is the makeup day for uh, let's say Lincoln's birthday. We'll have another makeup day on 28th, which is next Wednesday. We meet anyway on Wednesday regularly, but uh, it's gonna be Monday schedule. So still, 3 o'clock we meet at 3, and we'll have 2 hour class uh, next Wednesday. Okay, so we were just about to uh, start on the ROI macro part five. But we wrapped up part four last time. So we basically understood. I gave you an illustration of how uh, Fed funds rate works uh, between the commercial banks and between the customers of the between the bank and the customers of the commercial banks. So let's see what this video number 5 is talking about. So let's take a listen. Fed funds rate is the benchmark interest rate. Um, so, and I also Yeah, we understand why it is the benchmark interest rate for short-term lending, for short-term interest rates. So answer to my own rhetorical question, which was what does it have to do with the Federal Reserve? And I said it has nothing to do with the answer is yes and no. I mean, it's not like the Federal Reserve. It's not like the commercial banks are borrowing from the Federal Reserve, right? In other words, Fed funds rate is not the rate applied to the commercial banks by the Federal Reserve. It has nothing to do with that. It's simply Fed funds market. Because it's called Fed funds rate because it is uh, the rate determined by the market, called federal funds market. And of course, think about it. What else would you call it? It's all the banks, all the commercial banks within the United States, every state, right? Federally, they offer to lend and search the counterpart to borrow from on a federal level. So that's why it's called Fed funds market. Okay. But why the question, my answer to the question, yes and no. I already answered why it is no. Why Federal Reserve is not the owner of the one who owns this market, or the one who controls this market. But also I said yes. How come? I mean, how can it be such ambivalent? Well, uh, it is yes because in a way, Federal Reserve works through the market system, Fed funds market. It's not Federal Reserve sets the target rate for the Fed funds rate. Federal Reserve, once again, I repeat, Federal Reserve sets the target rate for the Fed funds rate. Setting the target means you can set the target, but the actual market may not conform to the target. Make sense? Think about it. If you're in the military, um, of course, in the U.S., the Second Amendment, anybody can own the gun. But I, personally, I find it so, wrong. It's not like 1776, right? Okay, so we don't need a militia. Let me skip this part. Well, it's a political, moot point, but I personally find it. at the market economy is that everything has to work through the market. In other words, what I'm saying is Federal
Okay, so yeah. Oh,
monetary policy and monetary theory in a market economy is that everything has to work through the market. In other words, what I'm saying is Federal Reserve sets the target rate, but then they cannot say, so we set the target rate at 3%. So from tomorrow, starting tomorrow, 0 hour, the next day, let the Fed funds rate be 3%. Actual Fed funds rate in the market be 3%. Or less, you'll get executed. It's not like that, right? Anyone who in the Fed funds market, if commercial banks charge anything other than the target rate, you'll be in violation and you will be punished, right? Is it going to work like that? No, it doesn't work like that. That's not a market economy. That's not a free market economy. In a free market economy, you've heard this over and over all your life. What determines the price in the market? You've heard this, demand and supply, demand and supply. Okay, they will. So Federal Reserve will work through the market system, and by affecting the funds available, and by affecting the demand, they try to bring the actual market rate close to the target rate. Okay, so in that sense, and that market mechanism, we're going to come back to that shortly. And I said there are a couple of mechanisms they use to do that. So if we go back to the, this is a brief, recent, trend in Fed funds rate. I only posted up to December 2018, but it's a well-known fact that in 2008, what happened around, actually, you all remember 2008. That was the year, that a historic moment in the financial market, the financial crisis, right? But actually, the financial crisis was instigated by the housing market crash in 2007. Around September 2007, the housing bubble bursted. The housing market crashed, and then as a result, in 2008, full-blown, stock market. After right after the housing bubble bursted, a lot of stock market crashed too. So from already, early 2008 was full-blown financial crisis, and to fight the financial the recession induced by financial crisis, the Federal Reserve lowered the 0%. Now, the actual market rate cannot be exactly 0. So the target is not a point; it's a range. So the target range is 0 to 0.25%, and they through the market mechanism they brought within this range. So actual market Fed funds market rate fluctuates between.
So let me just sum it up briefly, right? Basically, we've had a long period, almost a decade of very, very, very historically unprecedented low benchmark rate of 0 to 0.25, right? And then they slightly started to raise it by another quarter quarter percentage point, right? In 2016, and then as the economy was recovering from that financial crisis, then they were even pushing it up to 2.5 in 2018. And then since then, what happened? Of course, as I said, this video was made in 2020, so all the data we had, whatever data I had available up to that point, obviously, was like 2018. But since then, look, I'm posting. I have posted, right? It's only a matter of diligence. If you diligently research, and a lot of the even diligently looking into the topic folder, you will find, okay, there is Fed funds rate history, and also even this is just the screen grab of this page. If you click on it, you will see the history, right? From 1990 to 2023. I mean, we can go all the way to. We just don't have the data for 1980s, but in 1980s, the Fed funds rate was even as high as 15%. But that is such a distant past. So if we just go back to 1990, right? You see the Fed funds rate were generally, above 5%. I mean, historically, the mean of the benchmark interest rate is about 6%. So think about it. 92, they dropped it to 3%, but it was because of the brief recession at the beginning of not the beginning, but right after the desert storm, right? And then see, just in 5 years, back to 6%. They are generally, currently we are here. Currently we are here, but that was the level of 1996, right? And then you see they were generally somewhere in the 5 to 6% range, 2000, right? And then 2001, 2001, there was a Y2K fear, right? Y2K, if you remember, I mean, some of you may remember, some of you were not even born at the time, but as the millennium changed, right? There was a fear, about the all the computer systems might crash, and the world will be there will be a worldwide chaos because of some people really believed it, and because that was the reason for the recession in the early 2001. So they had to lower the interest rate, and it was down to 1%. But then, since then, right, started to recover, and then so we were. So the benchmark interest rate was somewhere around 2 point. I mean, even in 2004, it was like this. That was not a bad time. I actually got a mortgage around this time, so my mortgage rate was not that bad. I mean, my mortgage rate was like, I guess at the time it was about 4% because I had prime category. I was prime category borrower, and then 2008, no financial crisis until then, but September of 2007 was subprime mortgage crisis. So the rates started to go down, and then October 2008, October dropped it to 1%, and then December 2008, financial crisis broke out around this time, October of 2008. So in December, they lowered it to 0 to 0.25%. Once again, it's a range. There's no, it's not a point value, but range, because you set the target range and you try to bring the actual rate within the target range. So always, set the target as the range value, not as point value. Then that low rate was held until 2015, December 2015. And then the rest is, as you saw on my slide, until, December 2000. And then after that, 2019, and then there was a fear of recession by end of 2019. So they dropped it to 2005 again in March. And then by March 2020, they brought it back to, think about it. 2020, what happened? The pandemic. So the recession, there was, a lot of scare about, recession, fear of recession. So it brought the rate back to, it was just recovering, right? It was just recovering, and then brought it back to this. And since then, right, they started to raise it again because of inflation. I mean, especially the inflation was very pronounced during 2022. So they raised the Fed funds rate. Now we are, since July of 2023, we're still here. They are still holding it steady here. Although inflation is getting tamed. They are getting a good grip on the Federal Reserve is, actually having a good grip on inflation. So they are predicting the rate to come down by June of this year, but the Fed is being very, very, very cautious. So they are still holding it at around this level. Okay. So please, don't just, just pass by. There are a lot of things here, right, that would help reinforce your understanding, because the slide alone is not, cannot be updated. It's because I cannot make the video again. It's a very, very time consuming and very energy consuming job. Yeah, Carlos, I think you raised your hand. Carlos, did you raise your hand?
That was by accident. That was by accident. Sorry.
Okay, all right, no problem, no problem. Okay. So
within this range.
I'm gonna skip. I already.
So let's say S&P 500 is, and I said from the macroeconomist. Now it becomes a lot easier. So we need to. I'm not going to go over prime rate again. We already explained this, and the reason. And the relationship between the interest rate and the economy. First of all, you may think that you might have thought high interest rate is a good thing. And I said, from the macroeconomist perspective, high interest rate is not a good thing. Why? First of all, think about it. If the interest rate goes up, right? If the interest rate goes up, that's nominal interest rate. What's going to happen to the borrowing? Borrowing or the credit goes down. If the borrowing goes down, what does it entail? This means money supply. Money supply goes down. Why? Because companies are not borrowing. So what happens? People are not borrowing because interest rate is too burdensome, so they don't buy houses. Housing market is shrinking, right? Then what happens? The construction companies, will suffer. They will lay off people, right? Construction boom is gone. There's no more, order for new housing, new buildings, construction of new buildings or houses. Construction companies will have to lay off people. That's obvious. And businesses don't borrow. So what do? They don't expand. And it's not just not expanding. I mean, so borrowing goes down, the credit money supply will go down because as less workers keep their jobs, people who are laid off cannot spend money, right? So if they cannot spend money, then they cannot simply, restaurants will have less customers, less income coming in. Clothing stores will have less income coming in. Overall, it has throughout the economy there would be less money supply going around, less cash flow, and two, the lower output of the economy. That Y stands for income. Also, I told you in the previous videos, I told you income is the output, right? Because output eventually turns into income. If a car company makes cars, that's their output. But they don't just sit on the cars, right? They will sell the cars, and the cars turn into income, right? Their outputs turn into income. So output is the income unto itself, onto the economy supplier or the producer themselves, right? So the economy shrinks, right? However, the mirror image, the opposite is exactly the mirror image, right? If the interest rate goes down, credit goes up, borrowing goes up, lending goes up, money supply goes up, and which stimulates the economy. So this is something that might seem quite counterintuitive to a lot of you, because I was like that. I was 40 years ago, I was an undergrad student, and as an undergrad, I was a liberal arts major, and I didn't know anything about how the economy works. And at the time, I didn't even take any economics.
Okay.
And then
Forward.
we're still Bloomberg, major financial. One day you hear, the interest rates are up, bond prices are down. And another day they say interest rates are down, bond prices are up. And as a 18, 19-year-old, 18, 19, 20 year, I was back in 1980, I was around 19, so had no idea. I had no idea. Why? Because to me, it sounded like if interest rates are up, it sounds like a good thing. It must be a good thing. Why do they say the bond prices are down? And to me, if bond prices are down, that sounds like any price going down sounds like a bad thing, right? So it was a mystery to me. I couldn't, because to me everything, if interest rate is up, that's a good news to me. If I put my money in the bank, I will get more, money in my account in the future. In other words, my future value will be higher. That's true. But why is the bond market down? Why is the bad news to the bond market? And another day, interest rates are down. The bond market is, bond prices are good. The economy is booming. I couldn't make sense out of that. Okay. But then, only when I went to graduate school and changed my major and studied economics, then it came to me. And it's so there are many things that are counterintuitive in finance and economics. I've been telling you. One, we talked about why inflation is not necessarily a bad thing, right? Why borrowing is not necessarily a bad thing, because intuitively they seem like a negative thing, right? But in reality, they are not. Also, the relationship between the interest rate and the economy. In other words, there's an inverse relationship. A lot of things that are inverse related, and to you they are counterintuitive, right? But that's why you need to learn economics and finance, because by thinking logically, it teaches you logical reasoning, and through logical reasoning, you understand why these things that superficially on this seems counterintuitive makes perfectly logical sense. Now, again, so the Federal Reserve's role is, first of all, Federal Reserve is the central bank of the United States. No other country has the name like the Central Bank of England is, Bank of England. Central Bank of Japan is Bank of Japan. Central Bank of South Korea is Bank of Korea, right? But only in the U.S. the central bank is called Federal Reserve. The Bank of America is not the central bank; it's just a commercial bank, right? Now, as the central bank, they are the ultimate authority in monetary policy. That means they set the target rate for Fed funds rate, and also, and the actual Fed funds rate is determined by the supply and demand, the Fed funds market. And because they are central bank, they are the regulatory authority in commercial banking. And they are the lender of the last resort, meaning um, that means, when commercial banks cannot borrow anymore from the Fed funds market, then they come to the Federal Reserve to borrow. But once again, the term borrowing, this is actually a figurative expression. They do not really borrow from the Federal Reserve like borrowing from another bank. There's another way of, but it's a figurative expression. But actually, what they do is, get into a repurchase agreement with the Federal Reserve. It's called repo market. But we'll have to come back to that later. So in banking, there are two types of banking: commercial banking and investment banking. And back in the 1930s, there was a law called, Glass-Steagall law that was, legislated in the 1930s. But back in 1990s, Glass-Steagall was repealed. So Glass-Steagall was actually the law that separates the commercial banking from investment banking. So they worked. Commercial banks could not get into investment banking. Investment banks could not get into commercial banking. But after late 1990, I think it was 1998 or sometime around that, the Glass-Steagall was repealed, and the commercial banks were able to get into investment banking, and this caused all that financial turmoil. Actually, the repeal of Glass-Steagall was the planting of the seed for that financial crisis. Anyway, so commercial banking is regulated by the Federal Reserve, and the investment banking is regulated by SEC, which stands for Security Exchange Commission. Okay, there's also an agency called the CFPB, Consumer Financial Protection Bureau, which was created after the 2008 financial crisis. And this is an agency that regulates the non-bank lenders. Okay, you might wonder what are non-bank lenders, but we'll come back to this later. So this is the end of the.
Okay, so that wraps up video number 5 in this topic. Any questions so far? Any questions? Any questions? Okay, I take it as no. So we're moving on to part 6.
Fortune is my best friend. Hey, when it comes to writing, and I'm not.
Look, we talked about the what Glass-Steagall Act was about and why it was repealed in I believe it was repealed in 1998. But that was the onset of this the financial crisis that broke out in 2008. So it took from 1998 to 2008. Well, it took almost 10 years, and then during those 10 years, the collapse of the blurring of the line between investment banking and commercial banking was the culprit for the financial crisis, because it became the financial market became so chaotic, and a lot of moral hazard, a lot of unbridled and unscrupulous practices in the financial market, all started from this repeal of Glass-Steagall Act. Now, anyway, so back to our we understand now the role of the Federal Reserve in determining the Fed funds rate, which is the benchmark short-term interest rate, and not only that, but also 10-year Treasury for long-term interest rate as the benchmark for long-term interest rate. I said a 10-year Treasury note is the benchmark for that. But just let's start with the Fed funds rate first. So how does the Federal Reserve affect the demand and supply for demand for and supply of short-term funds, in the Fed funds market, with the purpose of bring the actual market Fed funds market rate meet the make it meet the target rate. That mechanism, the mechanism through through which they make it possible, they make it happen, is basically the essence of the monetary policy. Now, first of all, what is monetary policy? Of course, monetary policy is the whether to increase or decrease money supply, right? By the Federal. But why do they do that? When you increase money supply, from the previous slide, you saw that if interest rate goes down, then money supply goes up, right? So to increase the money supply, they will have to lower the interest rate. and vice versa. To decrease money supply, they will have to increase the interest rate. But why do they increase the money supply? To expand the economy, to stimulate the growth of the economy. Why do they lower the money supply? To cool off the economy, right? So when the economy is in recession, it's quite obvious they will have to stimulate the economy. So then they will have to increase the money supply. So then, a low interest rate is absolute necessity. And that explains why the benchmark interest rate is back down to 0%, right? But then they can do it in one of the two ways. They can lower the benchmark interest rate, which is the Fed funds rate, or increase it in one of the two ways. One is, a discount rate. So let me go to, okay, it looks like I'm jumping back and forth between these slides, but it doesn't necessarily have to go in the page order of the page number. So there are three tools that the Federal Reserve has under its belt or under its control. Three tools they can use for monetary policy. Open market operation. Okay, the other one is discount rate, and the other one is reserve ratio. Okay, monetary policy is basically Federal Reserve's action to control money supply to achieve the steady growth in the output of the economy, or GDP, and to stabilize the price level. In other words, stable inflation, stable moderate inflation. Now, discount rate is the most direct way they can affect the Fed funds rate. But I would rather come back to this later. I would want to discuss the open market operation first. Discount rate is, I briefly mentioned in the previous video, I briefly mentioned the
Can you help us? We need to drive away.
$250 deposit reference.
repo market operation or repurchase agreement, repurchase agreement. So it's relatively easy.
Now, repo operation, right, is also sometimes called reverse repo operation. So, but they mean the same thing. Reverse repo and repo, they are actually the same thing. It just depends on from which end you are looking at it. If you're looking at it from the bank's end, it's repo, repurchase. From the Federal Reserve's end, from the Federal Reserve's perspective, it's called reverse repo. And it's all done through, it's taken care of through the Federal Reserve's discount window. And that's why this is called discount rate. Okay?
Here, but what's more important, the mechanism that is really beautiful to watch or to understand is actually open market operation. So out of those three tools, I'm going to go to the open market operation first. Okay. Now, before we go to the open market operation, there are a couple of things we have to define before we go to that. So first of all, when we say open market, what does that mean? What kind of market are they talking about? They are talking about bond market. Okay. And open means is open to anybody. When we say anybody, that means when we say investors, to you, in your mind, probably the first thing that comes up, the image that comes up, is a person, right? But look, in the financial market, it's called individual investor, right? As opposed to the institutional investors. Now, individual investors are relatively smaller portion of the financial market. Okay, of course, there in terms of numbers of the actors, of course there are numerous, plethora of individual investors, but in terms of the dollar value they can mobilize, in terms of dollar amount, right? They can mobilize. There is no comparison between individual investors and institutional investors. And institutional investors are basically, banks, financial institutions, financial companies, asset management firms, most of all insurance companies. Now think about it. Insurance companies, they can mobilize huge amount of capital, right? Because they hardly pay out. I mean, if you have in your life, you will need at least three types of insurances. First of all, health insurance, right? Second, automobile insurance. Third,
this part.
home insurance, right? At least these three. Health insurance, major hospitalization. In your life, and I've seen any insurance company paying very hefty amount. Also invest in the U.S. financial market, and vice versa, right? And then, so bond market is open to stock market, bond market. They are all open to anybody. Anybody means therefore individual investors, institutional investors, domestic and foreign, right? Foreign investors can also invest in the U.S. financial market, and vice versa, right? So when so what is a bond? Bond is a debt instrument. In other words, bond is sold by companies and local and state governments, so-called municipal governments, and also federal government as well. So it's a borrowing, right? Debt instrument with standardized features. And the standardized features makes it possible to trade these bonds in the market. In other words, you don't if you buy bonds of company X, that means you're becoming a lender. They are borrowers. And just because you're in usual loan situation, you think when you lend money, you think that borrower-lender relationship lasts until the maturity. No, it doesn't have to. You don't have to be the lender until maturity. In other words, you can sell that claim to the money. You can sell the lendership to another lender, right? Then your lendership is just transferred to the new to the buyer, right? And that new buyer can also sell it to another buyer. So in other words, until the maturity is up, this lendership can be traded.
So you want to be a pilot? What an amazing idea. I know it can be confusing.
Oh,
I know there's a lot of information.
Right? So in other words, that's the bond. And bond is the ownership to a claim, right? To the credit that you made to someone, and then to a company. But it can be traded, right? So if you think about it, bond is just one of the three possible sources of business credit, right? Because if a company wants to borrow, it has three options. First of all, it can go to the banks, financial companies, and etc. Or it can go to the bond market, right? Or it can seek private placement. It can find private investors and set up a deal to get the capital provided by them. But the easiest, of these three sources, the most preferred and the easiest source is the bond market. And the standardized features of the bond is that they all have the face value of $1,000. The bond on the bond, the bond certificate, right? It's got a face value of 1,000. It's called par value, also par, and it pays interest because it's a loan. It will have to pay interest, right? Makes sense. And if it pays interest, this interest is a fixed rate because it cannot. You won't feel comfortable lending money to someone if your interest fluctuates with the market interest rate, right? So the interest rate is always fixed, and that interest rate on the bond is called coupon. And they pay this coupon twice a year. That means if the interest coupon rate is 10%, that means every 6 months you get $50. 10%, so $50. I mean, if coupon rate is 10%, then it is $100 a year, right? But they pay every 6 months, so 50-50, right? 2 semi-annual payments. They pay coupon rate times face value, so coupon rate times 1,000 in 2 semi-annual payments to maturity. That uppercase T means terminal time. So time to maturity, right? So and what else do we need to understand about the bond? Bonds can be classified by several criteria. So continuing on with the classification of bonds, first of all, bonds can be classified by who issued, right, the bonds, and how long is the maturity. So depending on the issuer, right, I listed only 2 issuers here. Treasury Department, Treasury, right, which is the a federal government, Treasury Department, and then corporate bonds, right, corporations. Treasury is the federal government's window for borrowing money, right? So the bonds issued by the federal government is called Treasury bond, but actually the bond is the name reserved for long-term debt instrument. And you understand long-term is the maturity greater than 1 year, right? Maturity greater than 1 year. So actually, If the maturity is less than 1 year, it's called a treasury bill. And if the maturity is between 1 and 10 years, it's called a treasury note, right? And if the maturity is greater than 10 years and up to a maximum of 30 years, it's called a treasury bond. Now, so treasury note, treasury bill, treasury note, treasury bond is the terminology reserved for U.S. federal government debt instruments, and collectively they are called treasury securities. Okay, treasury securities. And then for corporate bonds, the name reserved for short-term corporate bond is called commercial paper. And bond or longer than maturity longer than 1 year is called corporate bond. And corporate bonds can also have like 30-year maturity. There's no distinction between, in corporate bond, there's no distinction between the intermediate range maturity and really long range maturity. So they are both called bonds. And also, the bonds can be, by default, you think the bonds will have to pay interest. Yeah, because it's a loan, they will have borrowing, they will have to pay interest. But some bonds don't pay interest. And you might wonder, why would you then invest in a bond that doesn't pay any interest? If the bond doesn't pay any interest, it's sold at discount. Meaning, look, I told you, what is the face value of the bond? Face value of the bond is $1,000. It's standardized. There's only one type of bond whose face value is not 1,000, but in general, all the bonds have face value of 1,000. Then if it is sold at discount, what does that mean? It sells for $500 or $600, any amount at the selling price below its face value or par value. And then at maturity, you receive or redeem $1,000. So then what does that do? It's exactly working in lieu of the interest rate. Although it's not paying any interest, it is giving you capital gains. It's not interest because it's not paying you any interest. But think about it. You paid $500 for the discount bond, and it's in this case it's called as zero coupon bond. The bonds that don't pay any interest is called zero coupon bond. Remember, coupon is the interest of the bond, right? So bonds that pay interest are called coupon bonds. The bonds that don't pay any interest is called zero coupon bonds, and zero coupon bonds are sold at discount. So let's say you're buying a 30-year zero coupon bond, and then 30-year zero coupon bond would sell at very deep discount because it's such a long-term holding period, right? Long holding period. So if it sells for $500, then 30 years later, when you redeem it, you will get $1,000. So there's a capital gain, right, of $500, which is like 100% return, holding period, right? And then if you annualize it, you will see what it's going to look like. So and then I said zero coupon bonds are all selling at discount. And what does that mean? They are.
Here's one thing you need to do before buying anything online. Don't spend another dime on Amazon until you watch this.
Selling below par value, right? Now, it's not only the zero coupon bond. Some coupon bonds also sell at discount. Okay, and that means some coupon bonds are selling above par value, and that's called a premium bond, right? Whereas because it's selling at premium, right? And discount bond is selling below par value at discount, so hence called the discount bond. And some bonds are selling at par value. Okay, there's no particular name for bonds selling at par value. Maybe just par value bond. But usually either the bonds sell at premium or sell at discount. And our question is, what kind of bonds sell at premium and what kind of bonds sell at discount? Okay. Well, we will. Here's nominal interest rate. I mean, we've been using I for nominal interest rate and R for real interest rate. But let's say in this context, R represents the prevailing market rate. So in other words, what on average what the market is paying. Okay. And IC stands for coupon interest. So think of it this way: if the bond is paying 5% coupon, so this bond's interest is 5%. But average market interest rate, the average return you can earn from the financial market is, let's say, 10%. 10%. What's going to happen to the price of this bond? Now think about it. You have $10,000. You have $10,000. You just put it into an average investment opportunity in the market, and you can earn on average 10%. But if you put that $10,000 into this bond, you earn only 5%. What are you going to do? Is there anybody who is insane enough to put your money into this bond deliberately, intentionally, to earn 5% rather than 10%? No, obviously, no rational person would put their money into this bond. So what's going to happen to the price? Well, first of all, the price will go down because nobody wants to put their money into this bond, meaning that there is low demand for this bond, even no demand. If there's low demand or no demand, what's going to happen? The price will have to go down, right? And then the opposite is true of the premium bond, or it's exactly the mirror image. If the prevailing market rate is 5%, and this bond's coupon is 10%, what's going to happen? This bond will be in great demand. Great demand pushes up the price, so it will sell above par value. Okay, it makes sense. And then that leads us logically to the explanation behind the rationale behind par value bond. The coupon rate and prevailing market rate are equal, so the investors will be indifferent. Nobody, is willing to, pay more than just the par value, right? Alrighty, so
okay, so that wraps up this video, macro part 6, ROI macro part 6. Any questions so far? Any questions? Any questions? All right, I'll take it as no. And the time, currently it's 3:51, and I think it's a good time to take a break. So let's take a 10-minute break and reconvene at 4:01 or 4:02-ish. Okay? All right, let's take a 10-minute. All right, we're back. We're back. So before we begin, before we start with this is ROI and macro part 7. Hello, can you guys hear me?
Yes.
Okay, all right, thank you.
Yes.
Thank you for the confirmation. Sometimes I wonder because the only way I can verify that is through my second screen, and from my second screen I heard nothing. So I should hear myself from my second monitor, but then I wasn't getting any voice, any sound, from my second one. Oh, anyway, by the way, I was about to remind you that the second ROI test is starting tomorrow, right? Starting tomorrow. This email went out on the 17th, right? And then you will find it, of course, in the assignments section. This one is done, right? This one, it's not visible to you yet, but it will be it will become visible, right? 12 a.m. tomorrow, right? Okay. All right. So a gentle reminder that your second ROI test is coming up. Now, the mechanism, right? Or the mechanism behind the open market operation. Okay, let's take a listen.
And the reason we were talking about the basics of bonds was to understand what is the open market operation. And remember, open market operation is just one tool out of 3 tools that the Federal Reserve has under its control to implement monetary policy. And once again, the monetary policy is to increase or decrease money supply, to stimulate the economy or to cool off the economy, and it goes through the market mechanism. And the easiest tool to affect the interest rate is the discount rate, but actually more intricate mechanism or more pervasive mechanism, pervasive tool and smooth pervasive tool, most frequently preferred tool by the Federal Reserve is the open market operation. So we're going to look into open market operation first. And I explained in our last video what is the definition of open market. It's a bond market open to anybody, individual or institutional, domestic or foreign, right? So so basically, the Federal Reserve is intervening, entering the bond market and sell or buy back the Treasury securities, right? That's in the essence what the open market operation is. But let's take a look at the mechanism. First of all, let's assume a 0 coupon U.S. Treasury bond with 30 years to maturity. Okay, so that means this is going to be a discount bond because it's 0 coupon bond and it matures in 30 years, right? And obviously, it will have to sell below its par value. So the par value is the face value, right? 1,000. At a selling price, this means the price of the Treasury. So that's the selling price of the Treasury. So so therefore the price of the Treasury, selling price must be way below the face value. And let's say that is $500, right? Selling price is $500. So 30 years later, you will realize 100% holding period return, right? If you hold it until for 30 years, right? So that $500 is capital gains, right? But it's also called bond discount. The difference between the two is called bond discount because that's the discounted, that's how much it is selling for. $500 is how much it's selling for, and it is discounted by $500 from the face value. So then if you think about it, the return on investment, return on the Treasury bond, this 30-year Treasury bond, is calculated this way. Isn't it right? Value minus selling price of the bond, which is capital gains, divided by the selling price of the bond. Because the selling price of the bond is your initial investment. You have to pay that, right? You have to pay that $500 to buy this bond, invest in this bond. the cost or the initial investment and capital gains. And that's return on investment. In other words, this is the holding period return. But this holding period return has a special designation. The special designation is the risk-free return. Risk-free return. Okay, risk-free return. Why is it risk-free? You remember in the earlier videos, I said bank interest rate, right? Like in a savings account interest rate or CD, or the CD, are risk-free because the banks will have to pay this to you when the CDs mature and you redeem your money, right? And most of the banks in the U.S., all the commercial banks are basically FDIC insured. FDIC is a Federal Deposit Insurance Corporation. So by law, your deposit is guaranteed up to $250,000. It's all insured, right? That is one, risk-free return. And the other one is Treasury, U.S. Treasury. Why? We're going to get to that more into the reason behind it shortly. But think about it. No other bonds, no corporate or government, right, are safer than U.S. Treasury. Think about it. Yes, federal government is the safest borrower in the world. Why is that the case? Is that the case? Let's take a look. If I click on it. Now, think about it. U.S. Treasury has the highest credit rating, AAA, right? AAA.
Now, I'm going to just sum it up briefly because, it might take more time by the video. Now, think about it. The government, the fact that the U.S. federal government has the highest credit rating means that the U.S. federal government is the most credit-worthy borrower, right? And the governments borrow money. Why? Because, the sources of government spending, right? Funding for the government spending comes from the tax revenue. Isn't that right? So, but if tax revenue, they will be they will build budget, right? Government spending budget based on the forecasted or projected tax revenue. However, sometimes the actual tax revenue may fall below the projection. So then what do? They will need to borrow, right? But when they borrow, from the lender's perspective, right? The biggest concern for the lenders when they lend is whether the borrower will default or not, right? Makes sense? And most of that concern is taken care of by the credit rating, because credit rating is based on past credit history of the borrower. And of course, U.S. federal government is risk-free in that sense, right? Because first of all, why is it risk-free? Once again, think about it. The money to pay back, right? The money to pay back comes from the tax revenue. And the tax revenue is a function of, because tax revenue is the income of the government, and the tax revenue is a function of GDP, right? Gross domestic product. In other words, the total dollar value of the national income, right? So the country that has the biggest, GDP would have the biggest tax revenue. So obviously, the biggest ability to pay back. The ability to pay back is called solvency, right? So the solvency of the U.S. government is the greatest because the GDP of the U.S. government, and this was as of 2018. And as I've been telling you every once in a while, this video was made back in 2020, and as of 2020, that was relatively most recent data. However, as of the most, I have update. So the update is here. It says ROI Macro 7 update, and also the same thing, small, video. But I want you to watch this video because this one is too small, right? And when you maximize the screen, still, the pixels, small video and small has limited pixels. When you maximize it, it gets pixelated, which means pixels blur, right? So if you watch this, the 2018 data, right? But we are, of course, five already. We've moved ahead, five years. So the most recent data, economic growth for 3 decades. Okay, so notorious for it's the same place. It was 5 trillion. So 2022, right? Most recent data, the nominal GDP, that means nominal GDP, US $25 trillion. This is 5 trillion, it's like 5 trillion greater than 2018. And that was just over 4 years. And by percentage, it's, 25%, 1/4, right? Greater than 4 years prior, right? China also grew by about 5 trillion, because 2018 it was about 13 trillion, it's 18 trillion. Japan, Germany, India, UK, Canada, France, Canada, Italy, South Korea, Brazil, Australia, Indonesia. These are like 12 largest economies in the world. 12 largest. And you might say, other than, US and China, they are all under 10 trillion. US and China are anomalies, right? US is really an anomaly because the population of US is only 300 million, whereas population of China is 1.6 billion or something like that, right? Now think about it. If you divide this by 300 million, this is per capita, US per capita, 75,000. So it's average, right? You divide this by population, 1.6. It is like, it is 10th, right? So, and if you divide, it was, please watch this later, okay? And also, I have, down here, the data is here, right? If you open this, I guess I have already this downloaded somewhere, but let me just open first, because that must have been downloaded somewhere. I don't like it. I don't like it. But let me open folder. Okay, so I'll open and then click from here. Why is it taking such a long time? Oh, yeah. This is disappointing. I thought I made a change, so I'm gonna leave this on somewhere. Must have the cleaned. What was the file name? WEO. Here you go. This is it. Or this is it. Ah. Okay. Yeah, this looks much better. So, The green font, that's per capita. In other words, you divide it by the population. If you divide it by population, now US 75,000, Australia, Canada, Germany, UK, France, Japan, Italy, Korea. Italy and Korea are pretty much close. South Korea, that's of course. And then Russia, China. See, this is nominal by nominal dollars, right? And by nominal dollars, if you live in India, it would be like 2,465. 2,465 is almost like that's annual. But in the U.S., this would be like just monthly salary for a high school graduate. But then we cannot make a complete comparison just by nominal dollars because there's a purchasing power difference. I mean, a dollar in the U.S. cannot even buy what? You cannot even buy a hot dog. You cannot even buy a bottle of water with a dollar. But in India, a dollar can buy much more. In China, a dollar can buy much more. That's called a purchasing power parity. If you make comparison based on purchasing power parity, although it is 12,000, almost 13,000 nominal dollars, China, it's almost like 30,000, right? So this is in billions. So GDP, not per capita, but the GDP of China, based on purchasing power parity, is almost like 30 trillion, right? Well, U.S. is 25 trillion because it's 25 trillion. It's based on the dollar, so it's still 25. India is like 11 trillion. Japan 6 trillion. Germany 5 trillion. Going down to Indonesia, Russia, it's almost like 4.6 trillion. Although nominally it's right. Russia nominally 2.1 trillion, right? But it's like if you consider purchasing power parity, that means because a dollar stretches more in those countries. Although in South Korea they make $33,000 a year per capita, right? And it is 1.7 trillion, 1.8 trillion dollars. But in purchasing power parity, it's like $2.7 trillion, right? The lowest on that scale is Australia, 1.6 trillion. Although, so that means it's very expensive. I mean, Australia, it's very expensive. Everything is very expensive because Australia is where? Here, Australia. Oh, not that different. 1.724. But yeah, it's lower than their nominal GDP. So things are very expensive, right? In Australia, that can tell. So please check this out. Okay, please check this out. Let me get rid of this. All righty. What's going on? So that was the that's the update, right? Most recent data, right? So also, you can just check the video or go to the source data, right? So I'm going to
That's
skip this part. Skip this part.
there is that's the treasury will go down. Doesn't mean that treasury security is not. Now there are a couple of other three. Okay. Now, so now let's think about it. If risk, what's going to happen if the Federal Reserve sells more treasury securities? If Federal Reserve, actually treasury security is not issued by the Federal Reserve, it's issued by the Treasury Department. So Federal Reserve is like a window. The Federal Reserve is like a broker for U.S. Treasury Department. So Federal Reserve, they sell treasury securities. And suppose Federal Reserve sells more treasury securities, what's going to happen to the price? The price will go down. The selling price of the treasury will go down. Doesn't it obvious? This is a simple law of demand and supply. When there's more supply, right? When the demand is steady, what's going to happen to the price? It will go down, right? Think about it. If the price goes down, if the selling price goes down, what's going to happen to the risk-free? What's going to happen to the return? Now, this is a very simple and straightforward mathematical logic, but I've seen a lot of people who cannot make this, who cannot just perform this, just very basic logical thinking. Now, this number, this face value is a constant, isn't it right? Face value, because it's $1,000, no matter what, $1,000, right? And this goes down, right? So what's going to happen to the numerator? This will go up, isn't it right? The difference will widen, right? Difference will widen. That means
right. The difference between the face value and the selling price, as the selling price goes down, this will go up, right? Numerator will go up, and selling price goes down. That means the denominator goes down. So the fraction, this ratio, right, will have to go up, right? It's a simple.
The numerator will go up, and also since this is going down, it will have to go up. Just the logic, simple of carrying out this mathematical basic, you have to, right? Usually, people in the liberal arts are weak in this type of mental discipline. They all just hate the word discipline in the first place. It's like, oh, it's taking away the freedom. No, for your own sake.
Okay, let me.
Being sharpest, Okay, so first, the Federal Reserve sells more treasury securities, and then due to law of demand and supply, price goes down. Therefore, the risk-free return goes up. When the risk-free return goes up, what should happen to the rest of the bond market? Think about it. In the bond market, Federal Reserve, U.S. Treasury, right? U.S. Treasury Department, U.S. government, federal government, is the biggest player and the most influential player. Why? It's the safest borrower. And when the safest borrower is paying the investor, higher return, then what should the other borrowers do? They will have to follow, don't you think? When the safest borrower is paying higher rate, you cannot just be complacent and just still maintain your low return. Otherwise, you will lose all your investors to the U.S. Treasury. So you'll have to follow suit. You have to also pay higher return. So all the other bonds, corporate bonds, municipal bonds, they all have to pay higher interest, higher return, right? Higher coupon rate. So overall interest rate in the market goes. This is not only the bond market. Now remember, think about it. Didn't we look into three possible sources of business credit? One is through the bond market, from sale of bonds. Second, they can borrow from institutional lenders such as banks. Now then, think about it. Banks are also competitors. Banks are competing for borrowers, competing with the bond market for borrowers, right? And if the bond market is paying higher return, higher interest, then the banks will have to also follow, right? So then the overall interest rate in the economy goes up, right? And then therefore, money supply throughout the economy, sells more. So as the interest rate goes up, then what's going to happen? When the interest rate goes up, it becomes more difficult to borrow. If you're a borrower, I was saying, banks are competing for. That's true. Banks are competing with the bond market, and in the bond market, corporate bonds are competing with Treasury. So when the rate goes down, I should have started out with this, and I was explaining this case. If the rate goes down, this is a good news for the borrower. But when the rate goes up, if think about it, if the risk-free rate goes up, right? Overall interest rate goes up. Now, overall interest rate going up is a nice thing for the lender if you're lending money, right? If you're lending money, so you will put your money into the bonds, into the banks as the overall interest rate goes up. But then, what's going to happen to the money supply? Now, when you buy bonds, right? Or when you put your money into the bank, right? Money flows from the economy to the banking industry, and the banking industry, from the banking industry, also to the Federal Reserve. So what happens to the money supply throughout the economy? Money supply in the economy goes down because money flows from the economy to the Federal Reserve. And this is this is a bad news for the borrowers. Why? To the lenders, this is a good news because you get higher return on your money. But to the borrowers, the burden of paying higher interest is growing because it's so onerous and burdensome, right? Because you have to pay higher return, higher interest rate, right? Although overall interest rate is going up, the burden is higher. So generally, this discourages borrowing, and as it discourages borrowing, money supply throughout the economy goes down, right? Companies will postpone their expansion plan. They had planned for expansion, but because the borrowing cost is higher, they postpone the expansion plan. Then the hiring goes down, right? Overall economic output goes down, and it's exactly the mirror image. When Federal Reserve buys back, it's actually buying back. There were treasury securities held by the investors throughout the economy, and the Federal Reserve buys back, right? The treasury securities, and buying means what? Added demand, increased demand. As the demand gets stronger, what's going to happen to the price? The price goes up. Then what happens to the return? This price goes up. This is a constant. This is always $1,000. This is a constant. This goes up. So the difference for the bond discount, it narrows, right? It gets older. So this goes down, and this goes up. So what happens? Numerator goes down, denominator goes up, the whole fraction goes down. So the risk-free return goes down. And since the safest borrower in the financial market lowers the safest player and the biggest player in the market lowers the interest rate, then all the other corporations or municipal governments can lower the interest rate. So from the borrower's perspective, this is a good news. From the lender's perspective, this is a bad news. But from the borrower's perspective, this is a good news because burden of borrowing cost, also called cost of capital, right? Cost for borrowing capital, right? Borrowing cost goes down. And as the borrowing cost goes down, they borrow more. As they borrow more, and then they put it onto expansion plan and new ventures, and so it increases employment, not only of labor but also of resources. Therefore, money supply throughout the economy goes up, and the overall output of the economy goes up. Okay, economy grows. So now the picture is complete. If you think about it, this schematic picture is complete. Because previously, what I'm saying is, if you look at this, right? Since I already explained this, you understand this inverse relationship between the interest rate and the GDP, or the output of the economy. But it doesn't explain what causes the interest rate to go down, or what causes the interest rate to go. In other words, it's missing the picture, the mechanism before the change in interest rate. Of course, there are two sources of interest rate changes. One is endogenous, the other one is exogenous. Endogenous means it's coming from within the system, coming from the system itself. Exogenous means from an outside source. Okay, so actually, this picture, this diagram is showing you the exogenous cause of change in interest rate. Exogenous, because Federal Reserve is intervening, right? Federal Reserve is intervening. It's an exogenous. Endogenous cause of interest rate change is the business cycle. right? When business is economy is good, economy is booming, more businesses will want to expand, right? And as they want to expand, they will need capital injection. So how do they supply the capital? They go to the market, right? So naturally or inherently, there's a reason for upward pressure on interest rate, because as they try to borrow more, that's the demand. So that pushes up the interest rate, right? Borrowing cost. That's endogenous. But outside the cyclical, factor, in other words, if it's not coming from the business cycle, then it is due to the intervention of the Federal Reserve. This intervention is called open market operation. Okay, and this completes the picture because it explains what happens before interest rate goes down or goes up, and why it is causing the interest rate to go up or to go down. Okay, so that is the open market operation. So in our next video, we'll discuss, how they implement, how they change money supply, how they implement monetary policy through discount rate and reserve ratio. So that's it for this.
All right, so that wraps up everything about this video number 7. Again, we have 3 videos left in topic 1, but you should realize that we are actually in topic 2 now, right? We are actually, what I'm talking about, what I'm saying is, collaborate session is a review. It's not the main pace. It's not at the main pace of the. It's not at the regular pace of the main lecture. The main lecture is delivered through the pre-released videos, and the pre-released videos are now here in topic 2. I mean, even topic 2, it's all done. I mean, everything is already grayed out. Oh, part 1, part 2. So these are not the videos. These are just the links. But these are videos. So that means, financial statements intro 1 through 4, 5, 6, 7 already passed, and we are here. The class should be here, right? So you need to keep up with the pre-released videos because that's the regular pace, right? That's where the class should be at this time, right? Again, I've been telling you over and over, I mean, through the announcements, through the emails I sent out to you, that the collaborate session is only a review and Q&A session. That was original intention of the collaborate, because if you have watched the pre-released video already, and then you have questions, then you bring it to the collaborate, then we can discuss it in the collaborate. But since you are not asking any questions, it became almost like a just going over the videos all over again. But the original intention was for the collaborate session is for Q&A. Okay. Again, tomorrow you have this test, right? Starting tomorrow, right? You have 3-day window, so please don't forget. Okay. All right. So we have 5 more minutes left, but if you have any questions, I will take your questions, right? Otherwise, I will I'll break it up a little early, right? We'll call it a day a little early if you don't have any questions. So, any questions so far? Any questions? Any questions?
No.
Okay. All right. Thank you, Naomi. Speaking for, I believe you spoke for the rest of the class. All right. If there are
Professor,
no. Yeah. Go ahead.
you said that somebody was giving the Microsoft class.
Oh, Yeah. Hold on.
I'm
Hold on.
interested, but I don't know. But I can
Hold on.
register
Yeah.
to the course.
I guess I sent out that email yesterday. But you have to go to the original source of the email. When I send the email, that is posted in the announcements, and in the announcements, right? It can be the link is there, but
But
if
when I
you
press the link,
okay, good. So
it give me a link to join by Zoom.
hold on. Excel certificate. See, here's the link, and which is taking you to this flyer they gave me. So all you need to do is just follow the instruction. Click here to register. I mean, of course, this is a graphic file, so you cannot click it. Oh, is it clickable?
Yes,
Yeah, I
you
think
can.
it's clickable. Okay, great. Yeah, and then once you click it, there must be an all right. So register, right? Register
Okay, but I
for.
put my name and last name and all the information, and it doesn't allow me
First
to
name, last
continue.
name. You did?
Yeah.
Student ID.
Yes,
Oh,
I did.
okay. But you haven't got, what you're saying is you haven't got back any confirmation email. Is that what you're
Sorry?
saying? Is that what you're saying? You didn't get any confirmation email. Is that right?
No, when I fill every blank, at the end it doesn't allow me to continue. Okay, let me
Oh,
do it again, and I'm
yeah.
gonna tell you
Did
what
you
it
did
is.
you did you did you click this register? And if you
Yes.
okay, then I guess then that's it. Your information has been sent to them, and so you are registered for one of these dates, and if you
Oh,
will
Professor,
join.
it say this meeting. Oh,
Hmm?
let me do it again. This
Okay,
meeting is for authorized registrants only.
yeah, so you should, if you have registered, if you have registered, uh, let's say for February 24th or March 2nd, then for you will be allowed in this meeting on this date. Okay?
Okay.
So for any other dates, you may not be allowed, right? But since I don't know what you are looking at, oh, what did I do? Did I? Uh, okay. I don't know. Let me make you a presenter so you can share your screen. But the point is, now I guess you can share your screen. But the point is, my understanding is that you can join this training through Zoom, or also you can attend in person. I believe, maybe not. You know, you wanna share your screen now. Everyone, if you the class is dismissed, so if you need to if you must excuse yourself, yes, you are free to excuse yourself. Have a great, and if you're leaving, have a great afternoon and have a great weekend. Good luck with your test. If you want to hang around, if you want to stick around and still, listen to what Ariane wants to say, you're also welcome too. Okay.
Have a great day,
Okay.
Professor.
All right, you two.
Thank you.
Uh, Take care, Naomi. Take care, Dean King. All right. So, Ariane, you're gonna share your screen?
Okay. Let me see.